When headlines scream about global conflict and markets start dropping, your first instinct might be to panic and sell everything. But before you make that decision, you need to hear what history actually tells us about investing during wartime. What I'm about to share could save you from making the biggest financial mistake of your life. Right now, fear is spreading faster than facts. Markets are volatile, news cycles are terrifying, and everyone's asking the same question. Should I pull my money out and wait for things to calm down? The answer might shock you, because when we look at actual data from past conflicts, markets behave completely differently than most people expect. Let me take you back to December 7th, 1941. Pearl Harbor had just been attacked, America was entering World War II, and investors were terrified. The stock market dropped 3% the next trading day. Sounds reasonable, right? Here's the kicker. Within just 1 month, the market had completely recovered. 1 month. From one of the most devastating attacks in American history. Fast forward to 1962 during the Cuban Missile Crisis. The world was literally on the brink of nuclear war. Soviet missiles were pointed at America, and everyone thought this was it. The market dropped 7% in 4 trading days. Then something incredible happened. It recovered in just 10 to 12 days. Even when nuclear annihilation seemed imminent, markets bounced back faster than anyone imagined. More recently, when Russia invaded Ukraine in 2022, the market dropped about 2.5% on the day of invasion. Within a month, not only had it recovered, but it was trading higher than before the war even started. This pattern repeats over and over throughout history. Why does this happen? It comes down to one simple truth. Investors hate uncertainty more than bad news. Once the feared event actually occurs, the uncertainty disappears. Markets can price in reality, even when that reality is terrible. It's the unknown that drives panic, not the known. But let me give you even more compelling evidence. During the 2008 financial crisis, the worst economic disaster in decades, the stock market crashed 57%. Banks were failing, people were losing homes, unemployment skyrocketed. It felt like the entire system was collapsing. Yet if you held on through the worst of it, your investment would have tripled over the next decade. After September 11th, markets were closed for nearly a week. When they reopened, the S&P 500 dropped over 11% in 5 days. It was one of the worst weeks in market history. But even then, most of those losses were recovered within 2 weeks. The COVID crash in 2020 was the fastest market crash in history. 34% drop in just 33 days. But within 5 months, the market had fully recovered and went on to hit new all-time highs. Here's where it gets really interesting. Let me tell you about 3 hypothetical investors who started putting $500 monthly into the stock market in 1985. First, there's the genius investor who had perfect timing. She waited for every major crash and invested only at the absolute bottom. Then there's the unlucky investor who had terrible timing, investing right before every major crash at the peak. Finally, there's the consistent investor who just set up automatic monthly contributions and never tried to time anything. After nearly 40 years, here's what happened. The genius with perfect timing ended up with $3.3 million. The unlucky investor with terrible timing still ended up with $2.1 million. But the consistent investor who never tried to time the market, she ended up with $3.5 million, beating them both. This reveals something profound about investing psychology. The person who never tried to be clever, who just stayed consistent through every crisis, ended up with the most money. Even the investor with the worst possible timing still turned her contributions into over $2 million, simply because she never sold. But here's the most important part. Missing the best days in the market can be devastating. If you had invested $10,000 in the market from 2003 to 2022 and left it alone, you'd have over $64,000. But if you missed just the 10 best trading days over those 20 years, your return drops to less than $30,000. Miss the 20 best days and you're down to just $18,000 with almost no growth at all. The cruel irony? Those best days usually come right after the worst ones. When you panic and sell during a crash, you almost always miss the recovery. You'd need to be right twice, selling at the top and buying back at the bottom. Even professional fund managers can't do this consistently. So what should you do right now while markets are volatile and headlines are scary? The same thing successful investors have done through every crisis in history. Stay calm, stay invested, and keep adding to your positions regularly. Don't try to time the market based on geopolitical events. History shows us that markets recover from conflicts faster than anyone expects. The worst thing you can do isn't bad timing or buying at peaks. The worst thing is sitting on the sidelines completely, letting fear keep you out of the market while everyone else's money grows over time. I'm not changing my investment strategy because of current events. I'm still dollar cost averaging into broad market index funds, holding my real estate, maintaining my cash reserves, and buying opportunities when they present themselves. The key is having a plan and sticking to it, regardless of what's happening in the news. Remember, time in the market beats timing the market every single time. Stay calm, stay invested, and let history be your guide. If you want to see exactly how recent policy shifts like Roth IRA changes, tax cuts, and the overall US economic outlook could reshape your portfolio, don't miss to check our previous video. Hit the link on screen or check the description now to learn which strategies could save you thousands and stay ahead of every financial curveball.